Hello, everybody, and welcome to Hash Rate. My guest today is the great and powerful Justin Bebis of Across the Chains podcast, ByteMasons, Oath, Granary Finance, BlockBytes, first of his name, King of the Andals. But first, a shout out to Mexi. You please use my code in the YouTube show notes. Get $4,100 bonus when you do. I use it. I love it. So join today. Use my code. Justin, hello. What's that?
Hi. 4,100? That's awesome. Dude.
Up to 4,100. So just so people are thinking, oh, I'll sign up and where's my 4,100? Not quite like that. You have to meet certain levels and do certain things. But yes, awesome. You can get up to 4,100. So pretty cool. And do you use Mexi while we're on the topic?
I don't trade, so no. I sometimes use Uniswap, Spooky Swap, if I need to move assets around. But I try to avoid. It's just a lot of time and energy that I'm not ready to spend.
Yeah, it is. It is. Weirdly, it is a full-time job, as I discovered. I basically spent the last year and a half to 2 years doing nothing more than DeFi trading, studying protocols, staking, using everything, studying everything, talking to everyone, making a lot of money, losing a lot of money, the whole 9 yards. So I immersed pretty hard and deep. I'd never used leverage until recently, though. That was the one thing I stayed away from. So. Yeah,
sometimes I lever up on Granary Finance, but that's more like for fun. I maybe do one trade a month if it's 100% confidence, but that's maybe every other month.
Yeah, I'm surprised to hear that actually. For someone who's so deep in DeFi, I would think that you've got the knowledge. You're sort of seeing around the next corner before a lot of people. So I would think, might as well trade. Right?
I personally think with all the information I have, it's unethical, one, and two, oftentimes you make these super high information trades and you're honestly are so far above the mean as far as your access to information that the opposite of what should technically happen on a fundamental level happens. So it's oh, I know this company is perfect to short right now, and it's not really a logical market. So
the market's too stupid. You're too smart. So you do the smart thing, right? And then you bet on the thing that's the best. But the market's too dumb to understand that, and they all go run over here because some meme coins got more juiced for whatever reason, and that goes up like crazy. And the thing that should have happened doesn't. I've experienced that myself. Weirdly, with Fantom. Of all things, right?
That's a very unhinged market, I think. Fantom and altcoins on there. Lots of things way undervalued, way overvalued. Lots of experienced players, and the thing is, there's so much market manipulation in DeFi and crypto that a team's response, a CEO's response to an exploit or some massive what should be a drawdown can be oh, let's just insider trade our way out of this, which that I don't go up against those guys, so I just sit around and buy magic cards. That's how I invest. But,
got it.
Yeah.
Well, judging from your very beautiful library behind you, you've done well somehow. So congratulations on all of that.
Hard work and getting very lucky. The combo
seems to be the combo that works. So what is going on over at Fantom right now? You used to run a podcast called Fantom Unchained for a year and a half, and then you're not doing that anymore, but you're doing a new one called Across the Chains. So tell me, just give me the high level, what the hell's going on at Fantom today?
Yeah, I think first of all, let's say what is going good at Fantom. The user experience is still excellent. It's great to build applications on. The development infrastructure is top of the line. We have pretty much everything we need. Some of it isn't as up to date as on Ethereum, but definitely ahead of the curve there. And the community is really strong. They have a lot of usership, a lot of a really broad user base. So you can get pretty high monthly active user numbers. And I guess the fourth big thing is the on-ramping and off-ramping from Binance makes it a really good chain for arbitrage and MEV. So that's what's going on Fantom. So it's
Tell me,
like,
wait, go back to the Binance thing for a second, because
Sure.
that's new information for me. So the on and off ramp from Binance, what do you mean by that? Binance supports Fantom in ways they don't support other chains?
Yeah, so you can on-ramp to Fantom Opera from Binance natively. So it's not you need to off-ramp to Bridge and then go to Fantom. So when we see the massive volume on SpookySwap, a lot of that is because SpookySwap is a center for arbitrage in all of crypto with Binance because of the low fees, the deep liquidity, and the easy on-ramping and off-ramping. So a lot of it's kind of like a nexus of DeFi arbitrage, and that's becoming a little less the case over time. With especially Uniswap v3 is like the really big game changer in terms of capital efficiency of swaps. But it's still kicking. Fantom is still really useful in that way, and that was kind of their big selling point throughout 2021. Is like, hey, look at the PD ratio of SpookySwap. Look at all the volume going through this chain. So just a good chain to build on as a developer. I would say there are some like fundamental issues on the business development side that make me as like the CEO question longevity and feel a need to diversify, which is where our deployment on Optimism comes, which is where our deployments on Ethereum and Polygon and some other chains will come. Is just the need, especially in this environment after the massive drawdowns, for our company to spread our wings, because focusing explicitly on one network, putting all of your eggs in one basket, in a time where network TVL may outweigh like the amount of security a network can necessarily provide. It's just sketchy, and Ethereum is once again in the bear market becoming the paragon of DeFi and of crypto, especially with the merge going successfully. It just, every project I think has their eyes on Ethereum and L2s right now, just getting as close to as possible to that nexus of liquidity and security.
Yeah, no, I agree with you on all that. So with Fantom, I mean, really, I think I've been trying to figure out in my own mind, like, what is a narrative, what is a transformative event that could vault it back up again, and the Fantom virtual machine seems to be the only thing I can think of. If that thing works as advertised and really provides the giant amount of new transaction capacity that it promises and the speeds that it promises, it could be doing, I've heard things like it could do 50,000 or 100,000 transactions per second. Who knows? But if it does, that's kind of Solana speed, but without the the crappy Solana centralization and crashing, frankly. So,
Yeah.
So what do you think about that? Do you think the Fantom virtual machine is a Fantom, or do you think it's a real thing that's coming, and kind of when do you think it might come?
So I think like the idea of one like whale of a product that they just slap down and say, here it is, we're now better than everyone else. I think that's more of a Fantom, so to speak, of the opera.
Yeah.
But what I've always liked about their technical approach is they're not focused on creating some, unique consensus. I mean, they have a unique consensus algorithm in Lachesis, but they're not interested in creating like a really crazy execution layer. They're not invested in reinventing the wheel. They identified very early on that probably the winner, at least for the next 5 years, maybe even 10 years, is going to be EVM. And their whole thought process is, how can we optimize the EVM? So how can we ensure that we maintain the support that developers look for, the UI, UX that has become an industry standard, and how can we do it in such a way that it's maybe even better than Ethereum? And I think they've succeeded really well in doing that at the user level. So gas is cheaper. At the node operator level, it's honestly getting cheaper and cheaper and easier to operate a Fantom node. And I think like with the hiring of Bernard Schultz, they're working on getting down to like the nitty gritty, the granular like opcode execution level, and breaking open that 15 transaction per second bottleneck that everybody in the industry is fighting against. I would say the big thing there is like, what are you going to do with all those transactions per second? You know, like
right. There's no demand for it right now, right?
Yeah.
So it's,
yeah. And
I
with
think
Ethereum sharding, you know, they're going to have plenty of chains to provide plenty of throughput, and it's just like, you know, who's going to be the winner? I think the obvious, like, no matter what, Ethereum is going to be a winner, and I think beyond that, we're talking about who can find niches, who can find product market fit alongside Ethereum, and I think Fantom has one of the more intelligent approaches. I just wonder if it's necessarily valuable, even in the medium term. But we operate on very long time frames.
So I think the next wave of crypto, and it's just my own personal opinion, he or she who provides web wallets and fiat on and off ramps, the easiest and compelling apps to end users, they will be the winner of the next cycle. And I say that, and it doesn't really matter sort of whether it's EVM or not. And I say that because the proof point of NBA Top Shots on the Flow network, which is a fucking completely bonkers non-EVM, you know, it's its own little creature universe thing. You know, it's like the Commodore 64 of blockchains, right? But nobody gives a shit, right? If you're a trader of NBA Top Shot, you don't even notice the underlying blockchain, right, any more than you notice the engine of your car when you drive it. Right, it's just sort of there, and it does what it does, and as long as it does, you're good. And you're just there to trade NBA shit. That's what you care about. So I feel like whoever sort of cracks that first wins. I feel like Flow actually has done a pretty good job of providing that, the web wallets and the fiat on and off ramps, and Near appears to also be doing a really good job of that. So we're right now in my mind the narrative at the moment is Tired, Avalanche, and Fantom. Wired, Arbitrum, and Near. I see a lot of stuff popping up on Arbitrum. Like a lot of the sort of energy in DeFi seems to, of like new stuff anyway, seems to have moved to Arbitrum from what I can tell. Comments?
Yeah, there is. Arbitrum has been kind of like a nexus of like long tail financial products, options, things of that nature. And a lot of it is because a lot of research and development began on Ethereum in like 2020, in the vein of like, how can we implement Black-Scholes? How can we implement options? How can we do it efficiently? And the end result of all of that research was it's too expensive to do it on Ethereum. So a lot of projects were explicitly waiting for an L2 solution that made a lot of sense. That and I think Optimism and Arbitrum came to the table with exactly that. So you have like a lot of firms, a lot of teams that were kind of ready to hit the races. And these are like people who are maybe Ethereum maxis or like really plugged into the Ethereum ecosystem, looking for a way to deploy on Ethereum. And that's what L2s give us. And our team is like that in a certain way. I think the L1 like narrative was good enough during 2021. I think probably the big thing to me, especially once we hit these first or hit the first few drawdowns from those peaks, is TVL on these networks is greater than what it would cost to perform a 51% attack. That to me was like the big glaring issue with most L1 blockchains. And honestly, like I almost would have feel more comfortable on a centralized L1 than a decentralized L1 because the security model was at least like we have cops, and we can like turn back the clock if we need to.
Let me just stop you there because I want to make sure like some people who aren't sort of native to our world understand what you just said. So I think it's super important. So TVL is total value locked. So the amount of money that's on the chain doing shit is greater than what it would have taken for someone to 51% attack the chain. So if there's $2 billion in TVL, if you have $1 billion, you can use it to get $2 billion. Bottom line. But don't you break the chain at the same time effectively? I mean, I'm not sure if that really works.
For Fantom, I believe you'd need like 66% to actually take over state and start like validating arbitrary transactions. So it was never like such an issue that it was like, oh no, this is like too much for us. And beyond that, like you see 2 billion TVL, how much of that is double, triple, quadruple counted? You know, especially
right.
when you're talking about Ethereum, like, you know, you have wrapped assets that have wrapped assets underlying, that have assets underlying, and every dollar
Plus all the
can
looping
produce.
that people do on things like Wonderland or, you know, back in the day anyway.
Exactly.
Or
yeah,
MIM.
Totally.
Yeah.
So the real like liquidatable assets are usually lower than you know what the security cost of the network is, which is why it was never like super urgent, but it's just like a red flag where you're making decisions and it's like, why aren't we on Ethereum? And over 2021 it was like, oh, because it costs, you know, $25,000 to deploy our systems. But now in the context of, you know, $1,300 Ethereum, low network traffic, like 2-3 Gwei gas, it becomes a no-brainer. And we'll kind of see Ethereum absorb a lot of kind of the top tier projects along with Ethereum L2s while it's relatively cheap to do so. And then once the market kicks back up again, we'll see a lot of the losers have to pack their bags and move over to L1s, like we saw at the beginning of 2021. So it's just going to be like a constant fluctuation. And you know, the cool thing about blockchains is they're as poor the throughput is, they are pretty elastic. So you know, they can grow and shrink as necessary along with their economies, and you'll just kind of see like a broad contraction, which is fine. It's healthy. It's like an organic entity, which is part of the reason that, you know, the problem domain is so exciting. It's like we're working with this new thing that is like almost like a technical personification of us and of society and of everything. And you know, trying to codify collaboration, trying to codify, you know, organization and all this crazy stuff. So we're just going to see it again and again, and the L1 narrative might come right back depending on how much usership comes along with the next boom. And our goal is to just be positioned to capture whatever, wherever, you know.
Okay, so let's talk about that. Like, who are we? So you've got like 4 or 5 projects going on in parallel. So let's first talk about the ByteMasons and Reaper Farm, I guess. So what are the ByteMasons? Let's talk about that first.
Sure. So the ByteMasons are, I mean, we're a DeFi engineering firm, or maybe, I guess, lately a Web3 engineering firm broadly, because one of the problems we're working on is onboarding. Like, how can we create an onboarding solution where a user can sign in with Google and use MFA to engage with our site, instead of having to figure out what the hell cryptography is. So that's kind of our step into the broad Web3 dynamic. But we have we have 16 pretty experienced, I would say senior to principal level DeFi engineers. You know, we cut our teeth on the 2021 bull market. We were founded by Ethereum security engineers. We're all a bunch of nerds. And I think we have like a really unique, broad approach to DeFi, and I think we have a really intelligent perspective on where DeFi finds product market fit within finance more broadly. And that's like our goal. Our goal is to take DeFi to a point where, you know, we can step to the JP Morgan chase in terms of efficiency. I would say my eye-popping stat is like JP Morgan with $3.4 trillion of TVL makes about 4% revenue on their AUM. And Aave with 20 billion TVL makes about 0.03. And that's with like hundreds of millions of dollars of incentives being emitted. So like we look at stats like that and we're like, okay, you know, we have all this skill, we have all this engineering might, you know, we're not going to chase a rabbit's tail. We're going to figure out how we can take DeFi concepts, transparency, flexibility, robustness, and deliver them competitively to the greater finance market. And that's like where all of our efforts lie. And we've got 5 projects that we work on that are ongoing, and all of them are really deeply integrated, with the goal being, hey, we want to have the margins of TradFi banking, and that doesn't happen when you're emitting insane amounts of tokens, when you're like stuck in the, we need to be these rock solid, inflexible entities, because there's plenty of that. And the thing is, they don't work as businesses. And, we have, 28 full-time employees, 16 full-time engineers. We want to crack the looking glass a little.
Yeah, so a couple things. So I want to go back to your JP Morgan comment, because that's pretty interesting. Jamie Dimon fucking hates this stuff, right? Every time he's in front of Congress or a camera, for the most part, he's like, I hate Bitcoin, I hate crypto. And you just said, well, this is why, right? Because without crypto, he can extract 20%. He can basically put a toll booth up and take 20% of, the loot that's sort of in the river going by him, because he's at the center. Like, you have to go through him sooner or later. And DeFi sort of democratizes that and makes it more efficient at the same time. So all of us can be little mini JP Morgans and little mini Jamie Dimons, but we don't extract as much. But we all do way better than we do in the existing financial system, because it's democratized and anyone can basically be a fractional participant in banking and lending and exchanges. So yeah.
So how do we take that and how do we actually make it competitive? So, we've got Mr. Joe Savings Account earning 0.1% in interest. We have, JP Morgan charging you 28%, APY on a loan. How do we shrink that gap significantly enough to meet whatever the hurdle rate is for people to actually onboard into DeFi? And how can we do it in such a way that a sustainable business can exist and scale? And right now that doesn't really exist in
No, everybody's doing
DeFi.
like with lending and stuff. People are just taking out loans so they can leverage it to trade Bitcoin at leverage, 100x leverage or whatever. That's the primary purpose of the loans right now. Nobody's taking out house loans, car loans. The real world atom-based economy and the DeFi economy don't really touch each other almost at all at the moment.
Yeah.
And that's I think that's what you're saying is you want to get it, you want to solve that.
Yeah, and the thing is, being true DeFi and having uncollateralized loans, you've got Maple Finance, you've got TrueFi that are just papering people up, underwriting these loans in a traditional manner and then just giving firms access to USDC, which is great, but that's not DeFi. That's not what we're trying to do. I mean,
well, we just had TrueFi on a couple of weeks ago, and the CEO, and you're absolutely right. He's doing everything TradFi, just using USDC to push it around. His reaction, his comment was, just doing that alone, the existing financial system is so bad that just using USDC to push the money around, it happens immediately. Just that is miraculous in his world. And then the ability to track on chain what's going on, that is also miraculous. And you and I forget how miraculous just that is. Yeah. So that's he freely admits it's not really DeFi, but it's pretty
they're
interesting.
An order of magnitude more efficient than Aave and Compound. So, those are the guys that I think have touched on how do we find product market fit in crypto lending or crypto financial primitives. They've touched on it. I see a world. We have cutting edge yield aggregation tech. We've got lending markets. We've got stable coins. We've got stuff that I can't really talk about. We've got.
Would that be BlockBytes, perhaps? Because I see that come by. But
no, I can talk about BlockBytes.
Oh, you can. Okay, I wasn't sure.
Yeah, yeah.
Well, let me just go back to something because I want to ask a question first. So you guys are doing your own products. You're not a job shop. You don't do this for hire. Is that correct?
I mean, we sometimes take the software we make and do private label stuff and just say, hey, we can do what's going to take you 6 months in an afternoon. That is something
true.
that we talk to people about, but it is right now nobody really has our mass as far as strict DeFi engineering power goes. So siloing this, being hush-hush, working on stuff, being like really productive is like right now where we're at in our tech stack, I would say is ahead of where the market will be in like 6 months as far as like the big broad market categories. We don't really think options or things like that are going to have product market fit for a while until there's more liquidity, more institutional demand, more demand for like interesting hedging opportunities. We're kind of zeroed in right now on lending, stable coins, and yield aggregation and creation of investment products. And we do all this in-house, and we do some advisement. We have like service agreements and stuff like that. We do some like ghost writing, so to speak. But for the most part, like the stuff that's really high value IP, that's like, maybe this isn't going to be open source. That stuff we don't really shop around. But like we can create like, an industry standard lending protocol in like a week, like, right. With a brand and a security model and a risk model and everything. So the standards are not like super high. And so it just is like when there's money to be made, we can sometimes make it. But we're focused on, I think, more important stuff.
So let's go through your products. So starting with Reaper Farm. So you got like roughly 10 million in that. It's basically a bunch of vaults. You say to people, deposit your coins in our vaults, and you have different vaults for different coins. And we're smarter than you, so we will then take those coins and go get yield with them. And here's an estimate of what we think we can get. And it works pretty well. I've actually used it. I'm a fan of it. So I've used your products. It works great. I loved it. So, but it's only like 10 million versus like Beefy Finance, which is a lot bigger. Are you satisfied with that, or are there plans to expand that? What you're thinking on Reaper?
So as far as Reaper goes, like right now, the revenue, the margins for yield aggregation are lower than they've probably ever been. Demand is very low, yield is very low, everything gets diluted. So working on that at the moment is not super valuable, but where the value is Reaper as infrastructure for our other products. So where we talk about meeting TradFi levels of efficiency, Reaper becomes a back-end system that's able to manage underlying assets, that's able to program logic in so that, for example, I don't want to spill too much alpha, but UniV3, you can calculate the min and max that a position is going to be worth denominated in the underlying assets, for example. So what Reaper can potentially do is Reaper can open up a position, let's say with a totally under-collateralized loan or an uncollateralized loan. And we can calculate the risk of that position as far as the lending protocol's balance sheet is concerned or debt portfolio is concerned in advance. So you can deliver uncollateralized loans that way. In a way that's like has almost guaranteed security or guaranteed levels of risk. And at that point, you're underwriting margins as opposed to the entire position. Like, let's say there is a drawdown and interest accrues. How can we underwrite that? So Reaper enables stuff like that. Reaper enables, of course, like rehypothecation, which we're programming into basically all of our products. So we don't really see ourselves as like wanting to compete in the like really super simple deposit assets in auto compound whatever market, because it's really low hanging fruit for one. It's extremely easy. It's a very saturated market. And the revenue, I would say on 100 mil, you're probably earning like 10 grand a year, depending on, because a lot of that's going to be stable coins and a lot of that's going to be curve. And really, you're not collecting that revenue as a company. The LPs are collecting that revenue. So it just like is not the place to be investing money in. But infrastructure in a bear market, like we're still advancing our vaults for Reaper. But it's so that we can make our other products more effective and integrate more deeply. And that's about creating those DeFi rails to achieve TradFi levels of efficiency. So Reaper can take on money, and we know exactly what it's going to do with it. So we can take on uncollateralized or under-collateralized loans and we know exactly what's going on underlying. And so Reaper's position we can hold as collateral. And when you think about when you start tokenizing houses, things like that, suddenly Reaper can enable mortgages. You know, Reaper can enable all sorts of interesting lending primitives because, you know, the unsecured lending market's 119 billion. You know, the average person is paying 9.4% in interest, and DeFi can do way better. If I'm being honest. And we can do it with a way more intelligent security model, and we can do it in a way that is totally transparent, robust, flexible, and resistant to like economic disaster. So
the real answer with Reaper is a building block, not really an end unto itself, which down the road will enable uncollateralized loans for things like houses and, you know, and cars and broader atom-based finances.
Yeah, and then beyond that, rehypothecation. So, for example, like the Granary.finance protocol, really when we were doing market research for that, like going into like, we want to launch a grain token. Let's figure out what the economics are so we can make sure, you know, our raise is fair and our users like have a fair shake. We realized as it stands, like there's no way to make an Aave or a compound sustainable without like totally re-engineering everything top to bottom. So we were like, okay, we need to do something else. So right now, a lot of what we're working on is
well, let's introduce Granary first because we haven't talked about
that.
Yeah. So Granary is Granary Finance is another product of the ByteMasons. It is sort of like, my understanding anyway, sort of like Aave in that it's a lending protocol over collateralized, but it's sort of closer to Geist, I think, in terms of how it operates, where the users, I think, get you know, if they stake the coin, they get most of the revenue from it. Is that correct or not?
Sure. The grain token, we don't have a token yet.
Okay, my mistake.
Right now it is almost exactly like Aave. Really, all we did is we took Aave v2 and we added like multi-asset incentives because we saw that as a very easy value add. So right now it's just super simple over collateralized peer-to-peer lending. And it's what the average user would expect. Kind of, you know, really, Granary was kind of like an acquisition. Like we were doing advisement. We ended up like programming most of it, kind of going back to like, oh, we can program this, that, the other way faster than anyone else. So we were making it for other people, and then we were like, we're putting so much time and energy into this, it's just ours now. And so we hired the team and you know, started building on it, and you know, going into the financials, going into the nitty gritty, like figuring out what Granary's roadmap is and how it fits into our products. We immediately, when we hit the ground with our market research, we were like, okay, we can't release a token and be Aave or Geist or Radiant or Compound or whatever, because that doesn't work. The data is there that shows it doesn't work. You know, we're talking negative 360 million in revenue or in like profit or what have you. You know, we're talking like 0.05% efficiency on AUM. And then we look at like big banks, we're like, our idea with Granary was to be like a really nice analog to a credit union, like where it's going to be really fair to users. We're not really going to take any fees, or we're not going to take many fees. And now it's like, okay, how can we make something that actually works? So right now we're working on designing a module that can plug into all of our products that can take underlying assets and rehypothecate them with like a set-in-stone security model. So, for example, Reaper can take assets you deposit into Bitcoin. You look at a Bitcoin market on any peer-to-peer lending platform, there's maybe 10% of the TVL is being borrowed, you know? So in that context, lenders are making absolutely no money. It's cheap for borrowers, sure, but that like value model doesn't make sense. So now what we're doing as we're iterating on Granary is Reaper takes those underlying assets and it, you know, deposits them somewhere where maybe they don't have enough Bitcoin, or maybe it deposits them into Curve, and it generates interest for stakeholders. so that no matter what's happening in the market, no matter how much demand there are, or there is, it makes sense. And then from there, and the cool thing about the architecture is we can have markets, like we can have the plain peer-to-peer market, we can have the high interest, high revenue, rehypothecated market, we can have the white glove, uncollateralized market for like protocols and things like that, and segregate these risk models and have a way more profitable, way more diverse business. And that's good for users, that's good for us. So that's kind of what we're doing with Granary.
Let me restate, so just to make sure I'm super clear on this. So Granary,
Sure.
A lending protocol, people give you a bunch of collateral, and then what you do is you take what is given to you and you put it into Reaper, into one of the vaults over there. The Reaper vaults are smart about how to invest that collateral, smarter than Granary is, obviously. And it just goes and basically figures out what to do it, gets yield, and then funnels that yield back to Granary. So that's one way in which these two things work together, correct?
Yeah,
Did I get that right?
That is something that is in development right now. So
Okay.
that's coming in the next couple months as we kind of go boots to the ground with our fundraise. Yeah, it's relatively straightforward. I mean, we're just trying to emulate the success of banks and the success of traditional finance in a way that is top to bottom, like pure DeFi. So figuring out how to achieve those levels of capital efficiency, figuring out how to create value propositions that make more sense to the user, and how to generate more revenue for token holders or stakeholders or what have you. Like Aave's P&E ratio is like 90 something right now, and I like if I were to get in a meeting with a venture capitalist or an angel investor or something, if I had to sell something that had like a P/E ratio of 90 or greater, I don't know if I could really do it, without funding my own project. So really just escalating the efficiency to a point where we feel good about it is our goal with Granary, and that it can compete with TradFi, so that when this ByteMasons super financial app, comes out and users are onboarding with, their Google account and their 2FA, that they can like jump into these products and, we know that this app can compete with any fintech firm or what have you, is the ultimate goal. And I think like with DeFi's value proposition, like, hey, now you're actually making money on your assets instead of that 0.1% or what have you. Now I think the mass and the gravity is just going to build and build and build over time, if that's our goal and if that's other people's goals.
So 2 questions. First of all, are you guys venture backed? Have you raised money? Are you raising money? Like what's the story there?
So we're like totally grassroots community funded. So like when you saw like, Reaper.farm, 300 million TVL, 70,000, monthly active users, all of that was like with no token, like purely revenue backed. And then conveniently, we launched our token right when Russia declared war on Ukraine, and raised some from our community, and we're operating on that and kind of pushing our way through the bear market, developing our roadmap. But no venture backing. We have like some VC advisors that are kind of guiding us toward a Granary raise, and then probably eventually like an equity raise. We have, our legal infrastructure, like you wouldn't think we're not venture backed because we have 2 foundations, 2 token issuers, we have like a labs, we have a maintenance corp, we have all this legal infrastructure. Really that's just to protect our users and ourselves and be compliant such that when like the feds decide DeFi needs to get shut down, we don't get shut down, We see that as a really distinctive, honestly cost-efficient competitive edge. And now we're just figuring out how to take that and use it to raise money and team build and take some of our products to market. So that's happening with Granary now, is we're figuring out how in this hell of a market And the nice thing when you're like an ethics-driven organization and you're in a hell of a market, like, you know, the multiple is like realistic now. Like people raising funds, like promising a 6 to 10x, like when Bitcoin was $60,000. Like, you know, you can't really sleep at night then. But now it's like, hey, you know, we have reasonable goals and would like some reasonable funding so that we can reasonably execute them. Which is
you're a
is
serious
kinda nice.
person doing serious things. You're not like a fucking bored ape. You know, you're doing stuff. You're doing real things, and you like the fact that the market has become less insane, and it sort of matches your energy a lot better at this point. So
yeah, like we just want to engineer, like, you know, I want ByteMasons to be $1 billion firm. You know, I want our engineers to go down, you know, in this industry as legends, and you know that takes a lot of time. It takes really long time horizons. It takes a lot of effort, and it takes like a clarity of vision and of mission that gets muddied up when everything's euphoric and when valuations are sky high. So, you know, the thing is, like, the toughest thing about us, like, not releasing a token and not, you know, the main thing was it's overvalued and people are just going to be upset when things kind of turn back to normal, you know? And, like, these investors, like, once a drawdown happens, how many of them are just going to dissolve? But we think raising here in a bear market makes perfect sense because it's like we can grow with our investors and with anybody we bring on. And, you know, nobody's like micromanaging their portfolio as much as they were back then. So, you know, we can like actually have meetings and discuss strategy. And, you know, everybody in the space right now is serious. And that's what's exciting to us.
That's good.
You know,
yeah, I totally agree with you. The down market's always the best time to do the real stuff, which is why all these companies like, you know, Uber and Facebook and LinkedIn were all founded in down markets. Like, it's weird. It's like if you're founding in an up market, you're probably going to fail. But if you're founded in a down market, it just means you have a larger chance of success, it feels like. So question for you. You've mentioned Web 2 onboarding and, you know, Google 2FA. What about fiat on-ramps into your DeFi? Because I feel like the holy grail of DeFi is, you know, whoever figures that out, you know, fiat in, fiat out. I don't know what you're doing, but, you know, here's some dollars. And, you know, I put $1 in this side and, you know, a year later, $10 comes out the other side. That's all I care about. And that's, do you think that fiat part of it is a core piece of what you're doing?
It needs to be seamless. It needs to be like, I mean, Plaid has its issues, but it needs to be Plaid level seamless. You know, I think like the tech exists now to make it seamless. There are very few projects building toward that end. A lot of people are really obsessed with the DAO. Like, we need to be hyper decentralized. You know, there are a million people with guns aimed at our heads things, and it's like, what's the value prop of DeFi? The value prop is giving people a better deal and a better product. And if you're just obfuscating that behind layers and layers of decentralization and obfuscation, like, where are you going to get the adoption? So we see, like, onboarding, fiat is definitely part of that. Like, one of our, like, big achievements, I think, of our compliance team in our GC in the past 3-4 months is we're KYC'd with Circle now. We can get like really kind of seamless onboarding to our applications, and that's like part of the goal with these UX efforts is like we have all these cool apps, but I can't tell my mom to onboard because I'll need to sit down with her for an hour, you know.
Right.
And we like our ultimate goal is like we want all our moms to be able to like we want Facebook level onboarding, of course, with a DeFi security model and with a really intelligent approach to user safety, but that can be achieved with a Facebook level onboarding experience.
But you did mention this, that you are now you have integrated with Circle. When you say you've KYC'd with Circle, you've gone through their very rigorous process to allow you to integrate to their products, which include fiat on and off ramps. So that's a big step. I've actually, without telling you how I know this, I've been through their process, so I know what that's like. So that is a big deal, right? They don't let just any jokers in, and they really examine everything going on.
It was an arduous process, especially as like a DeFi firm. You know, it's like you talk to traditional investors and firms, and you're like, hey, we're doing this thing, and they're like, hey, where's the compliance handbook? And we're like, oh, we're writing it now, actually. As in, like, the standards aren't defined. Like, we need to figure out what compliance even means. It's like all of this stuff is steps toward mass adoption. And I think mass adoption, like, I gave a talk at a like top 10 bank recently, and like one of the main questions was like, where's adoption coming? Like, what's the point? Why should we care? And what they responded to better than, you know, you're never going to hear me be like a shill and be like, oh, it's coming tomorrow, you better FOMO in, or what have you. But like every single department responded really well to me saying, you know what, we're 3 to 5 years away from even being able to approach the idea of mass adoption. Because right now, marketing spend, like the cost of user acquisition in Web3 is like astronomical. It's insane. And if you're a VC, I mean, I would say personally as an investor, you know, I don't want to pay $1,000 a head for marketing. You know, I don't want to pay $200 to $500 a head getting people on my app. And when you factor in token incentives to, you know, to make it above that hurdle rate, like people delivering 100, 200, 300% APY, like that cost hits the books, you know, and a lot of teams, once the bear market started, found that out. And so we have a very much like no incentives policy unless it makes like total business sense, and that it will pay for itself, and that we can reliably dilute yields to reasonable rates. And that just like is hard. It's really hard.
Yeah. So we're coming close to the end of our time together. But I want to make sure I get a few questions in here first. So first of all, Oath. Tell me about Oath. What is that? I actually know nothing about it. I've seen it mentioned, and it seems to be some sort of metaverse token thing, but I'm not quite sure.
It's just a DeFi token. It's just a value capture token. Our launch on Oath.sale was very metaverse-y.
Yes.
Just because like we were very like friendly to retail, and retail was popping, so we're like, let's kick things up a notch for them. But really, when you're talking DeFi compliance, like we have an Oath Foundation. All of our DeFi is nonprofit. We're a software engineering firm. Okay, so you need to capture that value somewhere, and you can't capture it directly in Oath, or it's a security, you know. So really, as the weight of our ecosystem increases, and as we kind of can create opportunities for Oath, really it's a way for people to participate in our ecosystem and benefit from our growth. You can see, like I'm dancing around a lot of terminology here for compliance sake, but it's how we, you know, with all of this development, plan on capturing a lot of the value that we pull in DeFi, and then incentivize usership and incentivize development. That's the major purpose of Oath, it's a token that exists, I guess.
Got it. Understood. Okay, well, I want to ask you, so just sort of a crazy current events question. So Credit Suisse, $2.7 trillion. 33 Lunas, another way to look at it. The other night, they were talking that it might go under, and the CEO was reassuring everyone, and it kind of felt like steady lads deploying more capital moment, maybe to me. What do you think? Is Credit Suisse going to go under, or this is a big nothing?
I think it's a big nothing personally. You can't backstop a DeFi, like an uncollateralized DeFi protocol. Like everybody saw Luna coming for months and months and months. I was the, hey guys, Luna's going to go to zero, just reminding you guy on Twitter for a little while. I was a, hey guys, MIM has a lot of bad debt, you should be careful guy. And it's just like, nobody thinks about counterparty risk. Like nobody is thinking like a bank. Credit Suisse, I'm sure their risk management department could use a lot of work if they're in this situation. But at the end of the day, they have access to tools that, like, DeFi protocols couldn't dream of having access to. And I think, like, there might be some tumult internally, but honestly, I'm sure they can handle it. I don't think it's a Lehman Brothers moment, if I'm being honest. But I also don't know enough to say that with any level of certainty. So every little bit of news, especially when volume is low and liquidity is thin, is going to be blown out of proportion just to create some value somewhere for traders, And I see that as, like, we're going to see that over and over and over and over again. And the real narrative is we need to pay back a lot of this, debt and a lot of this, like, risk that was taken on during COVID. And it's the long and short of it. And I think a lot of us benefited quite a bit from the market craziness, especially people in this industry. And we just need to take our hits for a while things return to a mean. And I see the Credit Suisse thing as just another chapter in that book. And hopefully it's a book that could be closed safely after another year or so. But I'm not
so not a big deal.
Too much.
Justin says not a big deal.
And
Okay.
I'm the ultimate expert. Just kidding.
Well, I mean, Credit Suisse is not on chain. It's like Celsius. We have no idea what's going on inside of there.
Yeah.
It's a complete black box. So
yeah. The thing about Celsius is we do know they lost all their money.
Well, we know now.
On chain.
Yeah, now we know, right? But when they were doing the shit they were doing.
Wallet addresses. Yeah.
Right, which we didn't know at the time. So, I mean, I think we all sort of knew something was going on, but I thought it was sort of like low-level grift, not like the colossal,
Dude,
version of it that it turned out to be.
Like, it seemed like it was almost low-level grift compounding with, like, zero risk management. It's like a low-level grift turned into, a multi-billion-dollar evaporation explosion.
Oh my God! Yeah, it was
Craziness.
far more insane. I mean, it feels like the more we can see things on chain and the more transparent they are, the better it'll be for everyone ultimately. So. Yeah, so here's hoping DeFi wins. So, Justin, where can people find you online? So, first of all, plug your podcast and then your Twitter handle and whatever else you want to plug.
Sure, yeah. So, BlockBytes, you can follow on Twitter, BlockBytes.com. We have multiple shows, and there are going to be more over the next few months. That's probably where you're going to get the most face time with me. I talk about current events and things going on in the industry. And then at @OXBebis_. OXBebis was unfortunately banned for some reason. So we've got the underscore there. But you can follow me there. I have, like, insights occasionally, occasionally posting some artwork, occasionally, like, shit posting. It's really more of a normal account. The alpha is fairly thin, so don't get your hopes up too high. And then beyond that, ByteMasons.com. We're redoing our website, but that's probably, like, the best place to get a high level of where we're at. Reaper.farm, Granary.finance, some of our applications. And I would honestly, whether you want to be an investor, whether you care about DeFi, what have you, join our community. And, we're very serious, but we also, like, are laid back and joke around a lot. And I think it's a really good place to get no-nonsense information. Like, a lot of people, like, are pushing whatever their vested interests are. All we care about is our users' success, our company's success on top of that, and the success of the broader industry. So we always have people available to answer questions, and engineers and things like that. So everybody's more than welcome.
Yeah, and I've watched your shows, and they are great. So I can personally highly recommend them. So, all right, Justin, that's all the time we have. Thank you so much. My name is Mark Jeffrey. We'll see you next time.